Hello guys, welcome back to my channel. Don't forget to like, share, comment, and subscribe. Federal Reserve officials saw little evidence late last month that U.S. inflation pressures were easing and steeled themselves to force the economy to slow down to control an ongoing surge in price, according to the minutes of their July 26 until 27 policy meeting. While not explicitly hinting at a particular pace of coming rate increases, beginning with the 20 until 21 September meeting, the minutes released on Wednesday showed U.S. central bank policymakers committed to raising rates as high as necessary to calm inflation, even as they began to acknowledge more explicitly the risk they might go too far and curb economic activity too much. Participants agreed that there was little evidence to date that inflation pressures were subsiding, the minute said. Though, though some reduction in inflation, which has been running at 4 decade highs, might occur through improving global supply chains or drops in the price of fuel and other commodities. Much of the heavy lifting would have to come by imposing such high borrowing costs on business and households that they would spend less, the minute state. Participants emphasized that a slowing in aggregate demand would play an important role in reducing inflation pressures, the minutes said. Yet depth said that arched tone and on inflation is their top concern. The minutes also flagged what will be an important dimension of the Fed's debate in coming months: when to slow down the pace of rate increases and how to know if rate hikes have gone past the point needed to beat raising prices. While judged as a general dovish by traders who increased their bets, the Fed would approve just a half percentage point hike at the September meeting. Bob Miller, head of America's Fundamental Fixed Income at BlackRock, said the minutes seemed to be giving the Fed more scope to react as data flowed in. The intended message was much more nuanced and reflected a need to optionality by a central bank trying to assess conflicting economic data and shocks, he said. Staking out some conditionality going forward seems sensible given the uncredited nature of this particular cycle. The pace of rate increases indeed could ease as soon as next month, with the minutes stating that given the need for time to evaluate how tighter policy is affecting the economy, it would become appropriate at the same point to move from the large 75 basis point increases approved at the Fed's June and July meetings to half percentage point and eventually quarter percentage point hikes. But the ultimate level of interest rates seemed still very much in play. Some participants said they felt rates would have to reach a sufficiently restrictive level and remain true for some time in order to control inflation that was proving far more persistent than anticipated. Many, on the other hand, not the risk that the Fed could tighten the stance of policy by more than necessary to restore price stability, particularly given the length of time it takes for monetary policy to change economic behavior. Referring to the rates increases already telegraphed by the Fed, participant general judge that the blow of the effects on real activity had yet to be left, the minutes state. Okay, thank you for watching. Don't forget to like, share, comment, and subscribe. See you.